All right, welcome back to Wook Capital Management's 39th edition of our weekly Wook and Review broadcast series. Wook Capital Managing Director Rod Alsman. Do need to read this disclaimer and let everyone know that Wook Capital Management Inc. and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from your professional investment advisor and to make independent investigations before acting on the information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any actions you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results, and all investment decisions of an individual remain the specific responsibility of that individual. So, with that mouthful out of the way, I'm going to pretty quickly go through this week's newsletter. JP, if you could pin the tweet thread while I go through it, appreciate it. So yeah, we had highlighted a few pieces of news from this week. The main one, it's the last day of the quarter, and it's just been a stunning resurgence of this rebubble here to date. So we ended the quarter with indices close to their highs of the year. In the case of the major indices, Nasdaq is just a hair off of its highs of the year. S&P's at its highs, and the IWM is a little shy, still 5% shy of the highs it reached in February, but also up meaningfully year to date. So huge spread that we've been talking about for some time that really widened after the banking crisis between Nasdaq and the other major indices. Obviously the headline about Apple hitting a $3 trillion market cap, and the stock just continued to go up today into the end of the day. Closed at about $194 per share, about 3.05 trillion in market capitalization. I put out a poll on my personal account earlier about what people think Apple is going to return going forward over the next 5 to 10 years. Obviously, the poll is not 100% done. It's still open, but with about 250 votes, I have it on. Again, I'm sharing my screen in the Wook Capital Discord, and obviously, if you're listening to this recording, you'll be able to see the screen as well as hear the audio. It's fine if not. But the plurality of respondents so far, at least, have found that they see a 0 to 5% range as the likeliest 5 to 10 year annual return for Apple. So pretty pessimistic about forward returns. When I opened the voting, most of the responses were 15% plus. It's shifted over the course of the day. So now about 70% of the respondents see an annual return between 0 and 10% for Apple over the balance of the next decade, or of this decade. I made a point that at its current valuation, if you think it's returning north of 15%, you effectively think Apple will become a $10 trillion or so market cap company by the end of this decade. So again, going back to conversations we've had in the past about what is the commensurate operating income growth and operating income that you would need to see at that point in time to justify that sort of valuation. I mean, we're talking about needing to see $500 billion or more of operating income by the end of the decade to justify that for Apple. So I'm highly skeptical of that. I did get some good engagement from some folks who think Apple will just continue to take more value share at the expense of others. But I think that's the key point, is that the math doesn't add up. If you think everything is going to keep going up in value, that is not going to happen. The math doesn't add up because there will be winners and losers, and everyone can't win. The size of the pool is not magically growing. So, for now, though, whether it was end of quarter balancing, whether it was window dressing, wanting to show your investors that you are in fact invested in the future and you own Apple and NVDA and all these other technology companies, as of your end of quarter reporting, we'll see how that pans out. I'm inclined to think there's quite a lot of that, quite a lot of FOMO The fear greed index continues to remain in extreme greed levels. It's been extraordinarily high for several weeks now, which again, levels can go on for a long time. That whole solvency thing. But been a rough year if you're someone who invests in value and sees things like that, which I do. So, anyways, book club. We had our last book club on Tuesday. We talked about Michael Mauboussin's Think Twice, which has some really great discussion around cognitive biases that we are all kind of susceptible to in our thinking, and the Think Twice moniker being about trying to improve our decision making by trying to be aware of those cognitive biases and trying to as the name says, think twice about them before we go forward and make a decision. So for July, end of month, again, it's the last Tuesday of every month we host the book club. We'll be back talking about Howard Marks' Mastering the Market Cycle, which I had ChatGPT give me a little summary of since I haven't read it yet. But I guess the 6 key points. The book, so it's not that old of a book. It's a 5-year-old book, but discussion around market cycles. Marx has always been big on cycles, and we've talked a few times about his latest, his more recent note about the sea change, at least in interest rates, and the belief that we're no longer in the world we were in for the preceding 30, 40 years of rates going down, and we're now in a new world of whether rates go up or whether they stay at where they're at. Who knows? But that it is in fact a different world than it was. At least that's Mark's view. The market clearly doesn't yet see that. We'll see who's right. But his point about the importance of understanding market cycles, understanding the role of psychology in investors, in investment thinking, positioning, predicting cycles, risk management, and the importance of patience. And just thinking about positioning, right? If we're in a cycle that's near its high, or optimism is very high, prices are very high, it's a good time to be cautious, right? And the counter is true too. So now to me is a great time to be cautious. It wouldn't be the time to be aggressive. There is not pessimism out there. Prices are not low, at least for certain sectors, and the market writ large. But yeah, we talked earlier this week during the open mic about how there's been an ongoing deluge of positive surprises in the economic data year to date, and that has continued and accelerated recently. So people are feeling good, at least in the investor world feeling good. Anyone who is long a lot of dog shit and technology is feeling great if they went into the year positioned that way. But right, forward returns are the thing that matters, and you can't eat past returns. So I always make this point: all else equal, if the price goes up and nothing has changed in the outlook, then your forward returns have gone down, and the inverse holds true. But the power of psychology is not to be discounted too much. Okay, so a couple watch list items before we can just kind of open it up and see what people want to talk about today. I don't want to belabor too much of this. So yeah, we mentioned it on Wednesday too, the Robinhood layoffs. I saw people discussing this notion that layoff activity might be muted over the balance of the summer. A little longer before some of them start ramping up layoffs. I mean, we saw a big downtick in initial jobless claims. It's obviously a noisy data series, but yeah, the labor market still looks awfully strong on net, even though you've got these headline layoffs that you keep hearing about in certain sectors, still kind of skewed toward technology. Certainly more toward white collar than blue collar, as one would kind of expect to see in a more typical market cycle. That cracking of the blue collar job market has just not happened, and it's not clear that that's going to happen imminently. NVDA, we talked about again this, I think, earlier in the week, so I don't want to talk too much about it. The notion that the U.S. is going to have more curbs on exports to China for their latest generation chips, as well as leasing of cloud services to Chinese AI companies is something the U.S. is also weighing. NVDA gets about a fifth of its revenue from China. A lot of these companies do have a lot of China exposure. So, for now, all of this is getting shrugged off. NVIDIA, of course, closed up meaningfully today, as people wanted to make sure their investors knew that they owned NVIDIA before quarter end. Closed about $1.04 trillion market cap, up about 200% year to date. All right, hot money is piling up at banks. It's starting to take a toll. Yeah, I'd seen this reporting in Bloomberg. I thought it was interesting, talking about the cost of capital for the banks in terms of, I don't know what Joe linked in this newsletter here. That's not the right link. But how brokered CD deposits are something that, yeah, Joe linked the wrong stuff here. Okay, I'll have to let him know about that. But basically that banks are having to pay more for deposits, right? So brokered CDs for some banks kind of being a source of those deposits, as well as the advances from this whole Federal Home Loan Bank system. So there's still going to be interesting to see what happens in the second quarter earnings for a lot of these banks, talking about what their, what the deterioration in the net interest margins might look like, the cost of the borrowings, what's the trend look like, while clearly the crisis is far in the rear view in everyone's mind. The problems that some of these banks are facing are still present, with cost of financing rising, and competition rising. And yeah, we'll see some more of that in second quarter earnings results, I think. And then last article that I'd included was on kind of this discussion around the Chinese EV market and this consolidation going on in the market. For many years, it had been just a very bifurcated market, tons and tons of startup Chinese EV companies, and as the Chinese government had wanted, there's more consolidation going on, specifically around some of the bigger Chinese players in the Chinese market. BYD, obviously the biggest. And yeah, kind of a take from one of the Shanghai-based automotive analysts that, quote, 80% of the new energy vehicle startups, if we count all of them since the initial subsidies, have exited or are exiting the market. So a lot of rationalization in the Chinese automotive market. Yeah, Joe, I'm gonna have to talk to him. He did not link the stories in the newsletter this time. But yeah, that's ongoing. Tesla market share declining in that market. Obviously, we talked about on Wednesday, that the expectation is that the Tesla deliveries in China are up in the low teens, which, okay, great, but that's not really in line with what's baked into the share price. So, all right, yeah, real quick this week, I won't belabor any of these points. If anybody who's listening wants to talk about anything else going on in the market, please feel free to request to come on up. If you want to talk about any of the topics in the newsletter or any other topics, very happy to go wherever folks want to. Obviously, we have a holiday week coming up. Monday will be a shortened trading day. Tuesday, for the federal holiday, markets will be closed. I'm sure some folks are taking a long holiday weekend. If that's one of you, I hope you enjoy it. I will be working on Monday. But yeah, that's all I really have, at least from the newsletter. All right. Not seeing any requests, so we can shut her down there. Um, Appreciate folks tuning in to this week's. Oh, Chris, I see you're requesting. All right. How are you doing, man?
Hey, how's it going?
It would be better if my stocks could start going up.
Oh boy. Yes. Yeah. Um, it's been a wild week.
It's been
A
a
lot of stuff
wild
has
first
been
half.
going up and down. Yeah, the first half of the year has been pretty crazy and it's finally over. Yeah, I liked your thread about Apple, um, about 10-year returns. I think it's a nice question to ask if you're an investor, right? If you're holding this stuff, and what do you think, right? The total return, right? Free cash flow and stuff like this will be in the next 10 years.
Yeah.
And 3 trillion is like that's a big number. It's really big. I mean, Apple makes a lot of money, right? So it's
So there's only one analyst that has estimates on the sell side, at least out through to 2030, and that analyst has EBIT at 225 billion by 2030.
wow.
So, you know, uh, personally, I mean, that's already rich. Even if they were earning 225 billion in EBIT today and trading at a 3 trillion market cap, that's already rich from compared to the companies I typically invest in. So, I mean, this is just out of my league. I just don't understand it. I don't think
Yeah.
it's chiefly fundamental driven. It's kind of the point I was making with that earlier, right? Like mathematically, it's very difficult for you to get an attractive forward return when you're already this richly valued. And sure, if you're truly uh, holding for a 30, 40, 50, whatever you're claiming your duration is year duration, then okay, I could appreciate that you're going to make the point that over that long duration Apple has fantastic returns on invested capital, and therefore your returns are going to kind of skew toward that in Charlie Munger sense. But
Hmm.
look, I mean, it's just it eventually crowds out everything because the notion that
Yeah.
Apple's going to continue to return teens annualized for decades to come means Apple ends up becoming a larger and larger portion of the global economy, which I get some people believe that they will,
Mm.
eventually be the primary winner in whether it's AI or whatever they're trying to, narrative drive. But yeah, I mean, like mathematically, I just don't really see it. It's trading at a 24 times full year 23 EBIT. Sorry, EBITDA. That's 24 times EBITDA on an EBIT basis. It's like 27 times EBIT. So I
Hmm.
just really don't think people are actually buying many of these companies with any sort of fundamental view. I think it's been a lot of FOMO. There's obviously the passive aspect of it that if you're not if you're benchmarked to Nasdaq, right, and you don't have the right allocations to these winners, you've lagged. And
How much do they have authorized for buyback this year? I heard it was like 90 billion or something. They're doing a lot of buybacks, Apple.
I feel like they ought to bump the dividend. Honestly, it doesn't. I don't know. I just don't see it. I don't understand it.
You know.
Um, they authorized from the latest quarter, they had authorized another 90 billion, I think.
Yeah, I think that's what I was referring to.
Yeah. Which, I mean, again, it's a huge number, but it's 3% of market cap. It's not like it. Again, I'm invested in some companies that are able to, retire close to double-digit percent of shares outstanding every year. Those companies, unfortunately, their multiples continue compressing, so the stocks aren't, appreciating. But my point kind of is multiple expansion doesn't go on forever. And if your thesis is driven by multiple expansion, you're probably not going to have a good time when you're already at peak multiples. So then the return has to be from growth and operating income. I don't really know how
Hmm.
Apple's going to be growing operating income at these levels. I mean, I get people make the
Hmm.
points that they have pricing power.
Yeah.
People are willing to pay anything for Apple devices. And I'll be quite honest. I'm the closest I've ever been to switching away from Apple because I don't see
Hmm.
the innovation in their products. The iPhone, it doesn't really change every year. I watch kind of the Google and Samsung products loosely out of the corner of my
Hmm.
eye, and they get to me it gets more interesting every year to switch over to Android than Apple. But I understand a lot of people
Yeah.
feel strongly about Apple. There's the whole blue. message thing, which again I just don't
Like that's the
understand.
greatest innovation of the recent years is to push the blue bubble. And I don't think that was even on purpose. I think people just, you know, yeah, I don't know. But do you have the chart on Koifin pulled up with the EV to um EV multiples to
Hmm.
earnings EBIT?
Yeah.
Is this the highest it's ever been?
So it's not, because remember it on a forward basis it was higher in kind of the bubble years. Sorry, let me get the right screen up for those following. So like right now, the forward EV to EBIT is about 22 times. It got
Mhm.
up in 20
20.
because like 2020, right? It
Yeah.
the financial results hadn't yet grown. So like on a forward basis, it had gotten up toward 30 times, and then the
Yeah.
latest market highs, I guess in like late 21, November December 21, it got back up to like 26 times. So the
Yeah.
la- the so we're actually, on a forward EV/EBIT basis not yet back at the August peak, which was 23 and change times. So we're a little below that again on a forward multiple basis. Um,
Mhm.
Obviously, in dollars, where the share price is now higher than it was, at those points. So
That's an interesting trend line though, as you see from the peak COVID coming down. Because for like decades it was just going up like almost parabolically.
I apologize. I had for whatever reason I had the date through April. It wasn't going through to June 30th. So now that I've
Oh,
refreshed
okay.
it, the story's a little bit different. Yeah, EBIT's back up to 26 times forward.
Oh, okay.
Yeah, it's about as high
You're
as it's ever been.
I'm looking on the Discord and your face is blocking
Ah,
the there you go. Yeah.
there we go.
Okay, cool. Yeah, so this is pretty crazy. We're like at the top of the trend.
Yeah, like let me extend it, right? Let me go back 20 years. Obviously, this is the
Maybe you can
problem, right?
yeah.
Yes, in the mid 2000s, there were points where, on a forward
Yeah.
EV basis, Apple traded more cheaply. But let's remember, the iPhone hadn't even been launched in 2004.
Yeah.
It was just a much, 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 much smaller company in 2004.
Mhm.
Let me
And
add
they're
market
growing much
cap.
faster.
Right, exactly.
Yeah.
It was a $13 billion company in 2004. So just a complete different ballpark.
Yeah. Yeah, can you share a screenshot?
Yeah. Let me
That'd be
let
cool
me
for
share
everybody else
this.
in the space to see it.
Let me share this to the. But hey, Monative, Turtle, Sick, and Debo, happy to have you guys up. Do you guys want anybody want to chime in on Apple before we go away from Apple?
Yeah, yeah. I got a comment on Apple, and also connected with it a book recommendation that I've been kind of reading. I don't know if anybody's been reading The Changing World Order by Ray Dalio. There was like a portion in the book that kind of popped out to me when you're talking about the overvaluation of Apple. He was talking about when America got off the gold standard, and he thought the entire stock market would crash, but instead it went up like 5 or 6% up the next day. And then he realized that devaluing the dollar made equities more valuable. So isn't that kind of like a similar situation with Apple and most stocks right now? Because we've pumped so much money into the system that more of the equities seem more valuable relative to the dollar, or you don't is that a factor at all, or is it just straight like eat from the EBITDA margins?
I'm not sure for a company like Apple, it's that cut and dry since they have a lot of international exposure. I mean, all else equal, if you're a U.S. company exporting and the dollar weakens, it's good for you. But I truly don't know the intricacies for Apple to know how on net impactful um, currency has been as a headwind or
Yeah,
tailwind
but at
lately.
that time, oil companies were, or energy companies were, a much larger portion of the S&P 500. So that's maybe why you saw some of that play out, probably because of all the oil that's being exported, that being such a large portion of the index. And
We're not talking about the index, though. We're just talking about Apple.
well, he's saying that no. He was saying that stocks went higher when the dollar devalued. You made the point that if a company exports and the dollar devalues, yeah, that would make sense. And I'm just trying to make sense out of that in the broader sense, given the time period. So maybe, since the energy companies were a larger portion of the S&P 500, you might have saw it play out like that. That doesn't make sense.
Yeah. Oh, whoops. Yeah. So
It was like 15%. It was like 15% of the S&P 500. It's like 5% now. Sounds like tech. Back in the day, oil was all the smoke.
Yeah, well, it was all the rage, right? And then now, like the new gold is anything tech, or it's been tech since like the last 20, 30 years. So, all right. No, it was just a thought that I had, and like that one book recommendation that for the next book club, if anyone's been interested in reading some of that Ray Dalio stuff. But yeah, how's everyone else doing right now?
I just don't understand, Apple. I just really don't understand. I hadn't looked at the chart, but I pulled the chart up today, and I'm just kind of, I don't know. I just still am of the opinion that it's a false positive. Like, Apple's sending this signal that it's going to lead us into a new bull market, and I'm still not buying it. But
we should see if I mean, it has to show up in the operating results at some point. So we should see improved sales results. We should see margins expanding further, which obviously from a beneficial mix shift towards services will play out over time, and plenty of analysts have talked that up. But
but is the numbers like
there's no product coming out in the next, like the Apple Car is not coming out for many, many years. The VR AR headset, okay, it's coming out next year, but it's not going to be material. So to me, it's like, what is it that keeps driving this higher? Is it just that they can just keep taking prices up on iPhone and people will just keep paying more? Is that is that it?
They're going to keep bidding equities until they're comfortable that rates aren't going to go higher.
Who?
I mean, look at trend followers, people that run momentum strategies. They're all green lights go until.
But you're agreeing there's not any fundamental thesis that you're seeing that justifies purchasing Apple at these
No, but there's people that
valuations.
run strategies that they don't use a factor model. They just use price. There's a lot of fucking money that runs on strategies just like that, especially in the futures market. They're not indiscriminate and fundamental. They don't use fundamentals. A lot of these guys, they just use price. And what I'm saying is
right, but
you're going to
for
see
a
equities
5-10
bid.
year duration investment, that
You're going
doesn't
to.
mean
What I'm
anything.
saying is you're going to continue maybe to see equities bid until I guess the consensus is that rates have peaked, because I mean rates have not even reached 2008 levels, or the 2000 before the rates fell. Was it 2007? They're still not there yet. And if you look at the correlation between bonds and equities, they were positive for quite a while, but they have not oscillated at all. They've been pretty negative lately, probably for the past 4 or 5 months, which it's been like a sustained negative correlation, which if you look at the correlation, it hasn't been like that up until recently. And I'm saying is everything's fucked. The economy's fucked, probably a little bit, probably not too bad, but equities are probably just going to bid until there's a cap, rates peak out.
Yeah, I think going back to your earlier point, Rod, about Apple, yeah, the watch was released, right? An Apple Watch came out, and like people were saying it was, it's not that great, but like it became one of their best, it was really, if it was released by any other company, the numbers would have been amazing, right? But like Apple was already such a huge company at that time that like it kind of moved the needle a little bit, but it's still not one of their highest grossing revenue products. But and you go to AirPods as well, right? AirPods now they do like over 20 billion a year in revenue. Margins mid to high double digits for AirPods. Released in 2017 or 2018 around there. And yeah, it's like it's done well, right? And it's helped the company, but like 20 billion in revenue is, maybe a couple, percentage points for Apple going forward. So, I mean, how many more of these products they need to release, right? To,
Yeah, I
keep
mean,
the engine
on just a
going.
super simplistic, I guess to that point,
Yeah.
if a new product, let's just say the Vision Pro were to come out and add, which I don't think it will, but let's say it adds 10 billion in revenue, and I don't know that the gross margin on that product is going to be as high as AirPods or iPhone, but let's just assume it's
Yeah.
40%. That's 4 billion in gross profit. Let's call it 3-ish billion in operating profit. You slap that 25 times multiple, that's worth 75 billion. Like, yeah, sure, it's going to keep growing, but again, that's actually just a couple percent. If you added a massive new product line, it
Yeah.
just mathematically isn't enough.
And they're starting to put the squeeze on in their ecosystem. I mean, if you have an email account with them, you're going to go over 50 gigabytes like pretty quickly on iCloud, right?
Yeah, they're
So
very annoying. It's
you have to
really
pay.
annoying. I
Um,
don't, but it's very annoying,
yeah.
the incessant spam I get from Apple.
Yeah. So I think, either you take the time, right, to go manage all your stuff, or you let them basically store it all for you and forget about it, which most people do. And, but the thing is, like, how long will it take for people to realize, oh, I'm actually paying a tax every year to own these devices? Kind of, right? I guess with a MacBook, right, you're not really, with a desktop computer, you're not really paying a tax. I mean, sort of, but I mean, yeah, I mean, that's really how they're generating these, higher returns. But I mean, even then, right? Like, what is their earnings growth in the last year or so with all the sticky revenue, with their services, and they have the Apple One, right, which is all these different fitness and other things, and um, I don't know how many subscribers they have on these new services, like fitness. I think there's the arcade. I heard the arcade's doing pretty well. Um, I don't really know the numbers. I don't know if they split it up. Um, or they just bundle it all into services. But and then they have the Apple TV Plus, which it seems like it costs a lot of money for them to buy all this content, right? They're competing in the media space, which is like
Yeah,
not
but
really
look,
investable right now.
services is always going to be a higher margin than the hardware. So I'm
Yeah,
looking at the last transcript, and they were at 20.9 billion in revenue for the March quarter for services revenue, and that's obviously growing.
yeah,
They have more than 975 million paid subs. I don't know
yeah.
what exactly that covers, but that's what they mentioned last quarter.
Yeah, I mean, I think the corporate culture has probably changed too, right? Like with people, working in services, probably more driven by, conversions and getting people to sign up rather than actually creating a good product. Um,
Yeah, look, last quarter, products gross margin was 36.7, services gross margin
mhm,
was 71%. So,
yeah,
like, I understand that longer term narrative there, but
yeah. I mean, they don't really have to make Apple Music better than Spotify, right? Because they own all the devices that, that these people use these services on. So people will just sign up. So, we don't really see a trend of that weakening. So, I mean, that's good for Apple, but um, yeah, I don't know. Like, what would make you
yep,
worried
yep.
if you were
To
an
that
Apple
point you just
investor?
made, right? They have over 2 billion active devices out there
Yeah,
in the world that they can sell all of those services on top of, and that's going to grow in all likelihood every year.
yeah. I mean, like, if you were an Apple investor, what would make you worried? What would make you change your thesis? Besides, like, oh, this is not going to give me the return that this other investment will. Like, just if Apple alone.
Yeah, look, I mean, it's a real consideration, especially for anyone who's been a long-term Apple investor who has a huge unrealized gain on Apple. You know, that question you just raised of, well, what am I going to do? Sell my Apple, realize this big gain, and then what? You know, so I think there's a lot of people that are content to just say, you know, I'm very happy in the long-term, you know, thesis, or I'm very very happy the price keeps going up, so I'm not going to sell now because I think it's going to keep going up.
Mm-hmm.
But I mean, it is real. There's, you know, a huge tax, you know, a lot of unrealized gains out there for Apple holders that people are probably reluctant to realize.
Yeah.
Monative, I don't know if you had thoughts on Apple that you wanted to share.
Yeah, you left that Bloomberg space early. What happened?
Oh, yeah, I was listening. I don't know. I heard something and I'm just like, I don't know if you've seen the meme where the guy's just like pulling off his headset and has a scowl on his face. I think that was me.
Yeah, I was trying to, tweak him a little bit. He didn't respond. I mean, they went off on, when is it going to get to 4 trillion and all that. And, and
Just to give context for people who don't know, Mark Gurman, the analyst at Bloomberg who covers Apple, and Ed Ludlow and the tech team, they had a Spaces earlier, so that's what Monadive's referring to.
they're not analysts. They're not journalists. They're just fanboys. Seriously, they're just gushing over it like somebody at a at a concert for some big band or something. Anyway, so 4 trillion, they were talking about 4 trillion, what it's going to get there. And the analyst just says, yeah, just more of the same. They just need to execute. And I'm sitting here thinking, okay, these guys went on for 5 minutes. Not one person talked about the geopolitical risk, right? Absolutely nothing will work for Apple. I mean, by a mile, they have the worst geopolitical attachment to China.
Yeah.
They are
Yeah.
almost
I think even with the exodus of some manufacturing, I'm pulling up, iPhone is still, even by 2024, estimated to be almost 90% manufactured in China. Same with
it
AirPods.
doesn't matter.
Mac and
They also
iPad are even
have
higher.
20%, 30% of their market in China, right? So it's not just getting it made in China, it's also selling to China. So there is no way they get out of this unscathed, right? It's just not possible. So 4 trillion may in theory sound, just execute and you'll get there. But that really depends on absolutely nothing happening for the next few years between US and China. I don't want to I don't want to bet on that, but again, right? It's, look, compared to so many other stocks, it's not that bad. You know, you could say there's a shit ton of stocks out there in the market today's close that are far more expensive. Apple makes the money. Apple has cash. Apple also has a lot of debt, interestingly, because they refuse to bring their cash from where is that, Ireland. So this 90 billion, they're probably going to keep raising money against it, right? So yeah, it's interesting. I mean, look, I sold more today. I sold, so I'm now out of half my Norwegian position. I'm out of more than half of my Soxel position. I sold some more of my MongoDB. Let's see, there's a few other things I sold out today. I sold some of my Pfizer position. That actually I did well. I bought Leaps when the stock was at 95. It's now 125, so that did well. So I'm not dumping everything, but every day I'm selling. I'm selling. I'm not I've, like I said, I think the only buy this week was actually in the last 2 weeks was AbbVie. I started a position there. I like where it is, and I'll take that chance on building a big long-term position in AbbVie. I think I think it's a good place here from a fundamental, from a from a product positioning, and from the chart. So other than that, I'm still selling. I mean, but not from. I mean, I heard David here worry about the or say that the U.S. economy is fucked. I actually don't think so. I don't think it's the economy. Just because stocks are overvalued has nothing to do with the economy. Right now, every data we have says the economy is fine. Doesn't mean it's going to stay fine for long, but right now, I can't see anything that's going to upend the economy in any short time frame, right? So I don't think I expect to see a recession this year. Next year, yeah, probably. We're going to see something, but there's no data out there that tells me that a recession is imminent. Now, if we continue along this 2%, 1.5%, 1% growth rate for the next couple of quarters, heck, the market could be a lot higher, right? I mean, assuming that the direction of inflation is still consistent and it keeps going down a little bit at a time. Fed is not that far away from being done. They can talk all they want, but they are closer to done than they were any time in this year. So 1, 2 hikes, yeah, maybe that happens if things are really good. But even that, we need to see what the banks talk about. We need to see, the CPI report. I don't think they're going to make a call without reading into both of those, right? They're gonna have a meeting with the big banks soon, right? They're probably already talking to them, and you're gonna see Jamie unload if he expects something that he's not happy with. So we'll see. I mean, Jamie Dimon goes on the 14th morning, so I think CPI is 14th also. So it's a big couple of weeks coming up. I'm not negative on the economy, but I would say, given how cheap hedging is, it would be at a minimum prudent to hedge, anything that is on the tech side.
And thank you, Samanada, for that. I was going to note too. You're talking about estimates still for S&P earnings for 24 and for 2025. Both of those are estimated to be around 12% earnings growth, which is historically high. So you've got a lot of confidence already baked into the outlook. So,
Well,
to the point you just made about the real economy being fine, you've got very high expectations priced into the financial economy.
but Rod, think about this, right? 40 odd percent is really tech companies under the guise of either tech or communications or consumer discretionary, right? If you really start seeing some of these AI scenarios play out, let's say, Microsoft actually gets to that 10 billion run rate, sometime next year, NVIDIA's probably going to, like I've been saying, blow out the next couple of quarters by a mile and keep increasing their guidance. You're gonna see any AMD. Did I forward it to you? The article that Dylan wrote. If not, I'll forward it.
Yes.
Yeah. Okay. Yeah. So it seems to me that AMD is finally trying to put a stamp on it and get something out this year rather than next year, which is what I was thinking. You could see, I mean, and if consumer confidence continues to improve, you're going to immediately see it in Google and Meta earnings, right? So it doesn't take all that long of time or data points to boost tech earnings significantly, and we already know that there's solid underpinnings for industrials. So 12.5% is not that much of a reach, Rod. I think if things don't break down, it's gonna again surprise on the upside, right? Look, we have what are we for 54 60%, something 64% or something like that of the economy is consumer. So if consumer confidence is improving, why not? Why wouldn't we see a big earnings jump next year? That's not my base case, but I'm saying that you can make a case for it as long as things don't, break down.
Fair enough. Turtle, I haven't heard your input. Would love to hear it.
What's up, guys? Yeah, I don't have much for you really on the Apple thing. I don't know. I mean, it's a yeah, I don't have a ton for you. I wanted to ask you. I got a Wook question for you. I don't know if you
All
want
right.
to pivot to that yet.
Fair
Sure.
enough.
Okay.
Yeah, we've talked plenty about Apple. Let's go somewhere else.
Yeah. Cool. All right. So this is what I want to ask you. I had never been to your Discord before today. I'm really excited to dig into this more. But tell me more. Like, so Wook on the crowdsourced investment research. You're not going to talk a lot about like energy stocks, real estate stocks. Like, what type of stocks or what sectors, what works really well for crowdsourced investment
Well, I
research?
actually don't think that energy would be a bad sector if you get folks who have field expertise and have insights into it. Then that's going to give you some special knowledge. But consumer, of course, is going to be the sector I think that it's easiest for you to scour, crowdsourced information, generally speaking. And it could be some deep insight, like I've talked about obviously my views on electrification for heavy duty commercial vehicles for a long time now. So like I would think my insights pertaining to how commercial fleets are apt to adopt EVs, and kind of the system wide considerations for that stuff. Like I've been happy to share that for a long time. And that's the sort of stuff I'm talking about. People who have deep insight to certain sectors or industries, that they're able to share that knowledge, and with the hope of uncovering alpha that's getting missed. We have plans in the works to do a transformation of the GMEDD server that we're trying to finalize, which has several thousand people in it. I mean, the whole notion of crowdsourced research was what led to and what formed that initial GMEDD report that we published in Jan 21. So, to us, Wook is a byproduct of that, and we're hoping to test that thesis. And the reality is, for investment theses, these things take years to play out, right? Like, if we're just talking about price, that's one thing, but we're obviously trying to uncover deep insights that the market is apparently missing or not pricing in. Kind of flesh those things out and identify mispricings, and those mispricings, as we all know, can remain for years. So I think one challenge I find in this market is so many participants, price is the only thing they care about, and they don't even read financial statements, they don't follow 8Ks, they don't actually understand the business, they just care about price, and that's not what we care about. So it's definitely proven a challenge to get like-minded people and have these discussions. But like that's why I host these calls every Friday. I host the open mics on Wednesdays. We host the book clubs because again we're trying to learn, and investing is a lifelong process if you plan on actually actively managing your investments. So you can underperform for a few years, right? Like that shouldn't discourage you. You could outperform, and that shouldn't make you think you're hot shit. So it's definitely very much that's our thesis, is that we can achieve alpha with crowdsourced research. I think tapping into the just spaces, right? You get people on these spaces calls who have I scroll down and I know some of the people in the audience, right? Like Monative has deep insights. He has connections with people in the Valley that I would otherwise likely myself and as an individual not be able to tap into. And I love that I can have someone like that in my network. And hopefully my insights into freight and into commercial kind of fleets and that sort of stuff is helpful to other people. So I think the notion is you build up that network over time, and you hopefully can get value for everybody who's participating in the network. But it's absolutely still a thesis that we're on our way to hopefully proving out over many years.
Oh, I love that, man. That's really cool. And I think it's a really cool concept. I think that it's funny we're talking about Apple. I mean, I think about it from like I'm in wealth management, like that's my day job. And so I got like clients and stuff. And these guys, people that Apple and Tesla are like the two stocks where it's like you drive the car, you have the phone, you're up stupid, like you were just talking about. You have stupid cost basis on the stock, and it's like you've created a brand, a lifelong brand ambassador for the stock, for the company. And it's like, yeah, like you said, consumer is definitely you're right. That's the one that's where you're going to have that type of stock, because you're not going to have that with, that same brand loyalty with ExxonMobil or something. But I just thought that was interesting. Those are the two stocks where I really, see I really see it's almost like
and I saw Vanda track. I think they put it out in the journal again, like the amount of retail money flowing into those stocks, Tesla in particular. Still, we're just talking about absurd sums of money from retail flowing in. And look, I understand that people who had a long Tesla thesis, in the 5 or so years ago, and probably feel very much vindicated because the operation has absolutely improved markedly. But then it gets back to this whole discussion about forward returns. It's very tough for you to get a great forward return when you've already pulled forward many years of returns, like I kind of see as Tesla, right? So I think a lot of retail investors are very bad at actually looking at forward returns. A lot of them look at stock charts and and they like things that have been going up, which it's almost like a truth that if the stock is undervalued and its multiple is derated, that you're more apt to get a good forward return from a situation like that than someone who's already in the clouds. But yeah, Tesla's an anomaly.
It's wild, man. It really is. And it's that's you get a crypto level of brand ambassadorness when you have and it like price drives narrative, cost basis drives narrative. Yeah, man.
Yeah, that point you just made is crazy to me. I had put a poll out on my personal account a couple of weeks back, asking that exact question. It was something along the lines of, how much does your cost basis impact your thinking? And the correct answer should be that the only consideration is the tax consideration, right? The stock doesn't know what your cost basis is. But the truth is, and the respondents showed this, and kind of the psychology would be in line with this, that people obsess over their own cost basis, and it's meaningless, actually. I think about all of the people, Chris knows it well, right? With the Bed Bath and Beyonders, who have this massive sunk cost fallacy going on. Many of them have lost copious sums of money. And the situation is such that we know the Bed Bath and Beyond brand IP has already been sold to Overstock, who's opted to rebrand their whole business as such. The baby bankruptcy auction for the IP was pretty shitty. They're going to have a final auction for the going concern next week. And under all scenarios, there's no capacity for equity to see anything. Yet the equity still trades at a couple $100 million market cap in bankruptcy. And you talk to the people and they're like, well, I'm down so much, I'm not going to sell. What's the point in selling now? And again, so many people focus on what's happened in the past, where they're, if they're up or if they're down, as opposed to what is the forward return profile based on the risks, for the stock. And that's what I care about. All I care about is forward returns. But apparently I'm not the normal when it comes to that. And so far,
so you're a bear.
Yeah.
You care about valuation, it means you're a bear. No, I'm just kidding.
I'm very long, British American Tobacco, which is down almost 20% year to date. It's trading cheaper than it has, but for kind of the peaks of the .com bubble. So it's tough, right? You see the stock trade down and you think, well, my forward returns keep going up. But a lot of people see something go down, they're like, oh, I need to sell this, it's going down. But it just goes back to like, what are you doing? Are you trading, versus are you actually trying to make an investment into a business? And I think most people are doing the former, especially in the spaces discussions that I'll participate in throughout the day. During my workday, I'll tune into a bunch of them, and I get it, right? If it's a trader spaces, of course, that's mostly what they're talking about. But most people aren't actually investing, I think, in this market. At least, again, the people on Twitter, right? Which isn't to say that everyone in the marketplace is on Twitter. But no, look, I'm very bullish on the things that are beaten down. Mondev talked about healthcare. Healthcare, if you just step back and think strategically, it's a sector that is a huge swathe of the U.S. Economy. The U.S. continues to age, and in all likelihood, healthcare services will continue to be consumed at heightening clips. So you've got different regulatory risks, of course, across the healthcare ecosystem. And when you think about the fact that healthcare, I believe, is down year to date as a sector, I'll double check that. Like I think that inherently stuff like that, like staples, like tobacco, and things like healthcare, that have done poorly, you inherently are going to have a better forward return. It's just math.
And then one thing I like to add, Rod, is that also a lot of people on Twitter, they're really focused on US stocks, which I understand, right? Because they tend to go up a lot. But there's also a whole swath of investments around the world, right? Like Japan is getting really popular now. Like a lot of Japanese companies are buying back stock, and they're kind of becoming less conservative, right, with their capital allocation. But I mean, yeah, there's all these different companies and around the world, and it seems like people are very fixated on maybe 6 or 7 of them that are listed in the US as investments.
No doubt. And I think that's part of why the sad macro bears are so sad, is because there is a case to be made, and someone step in here smarter than me, but there is a case to be made that there's bear markets outside of US stocks. US dollar is bullish, right? Versus, USD JPY is right back to 145. That's right where they intervened the first time last year. So it's just interesting to me. When GameStop went parabolic, part of the reason I'm so attracted to you, Rod, and what you're doing is I rode that with you part of the way. I got in that thing early, and that was it, man. That was the last time investing was really fun, was Q1 of 2021.
But you know very well clear that what was going on in that month, that January, was nothing investing related,
well,
right?
that's exactly
it was very much a mania.
Oh, for sure. And that's really the point, is it's like Trump said about the virus. He's like, one day it's just gonna in the middle of the night go away. And it's that is what happened with the bear market. US JPY hit 145, then it hit 150, US 10-year hit 425, then everything was fucked. And then MOF intervenes, USD JPY goes down, and now Keith McCulloch's crying every morning on his show. So this is I don't know. I can't explain it, man. But that is what happened. And so I guess all I'm saying is that's the tricky part. We're doing, because I'm with you. I want to feel, especially, I want to feel like I can understand the businesses that I'm invested in, right? But how much of that in the short term, to your point, it's these unexplained forces.
It doesn't matter very much in months. Even in a couple of years, it doesn't matter very much. I mean, again, I talk about Allison a lot because I understand the business very well. And I think it is a prime example of, when you get something like a multi-year, multiple derating, people then think there's something wrong with the business, or that the stock's not going up, it's a bad business. Those sorts of narratives from a lot of retail, I guess, type and investors, even professional investors, not just retail. But then it's well, that's where if your view is in line with that of the market, you're going to get market returns, right? If you position yourself in line with the market and your view is out of the market. So as Marx would say, right, you need to have a different view and be more right to get extraordinary returns. So That's kind of what the hope is. Of course, we all hope for extraordinary returns, but you have to be comfortable with years of the market telling you you're wrong, in my opinion. And most people, I would say, from my experience, are not comfortable with that. And in which case, they probably shouldn't be actively investing. They should perhaps be satisfied with indexing and passive investing. So I always say it's really important to know thyself. I'm a-okay, standing in a room and everyone's view is opposite mine, but a lot of people are not okay with that. We talked about that Tuesday in the book club. How some of these psychological tests where you'll go through and they'll have the respondents to the psychological test all answer the wrong answer, but because you've heard 7 people in a row answer the wrong answer, you're more likely to answer with the wrong answer. So like all of these little cognitive biases, we're all susceptible to. But again, I just think it's important to know thyself. What is your objective? Again, if you're trading, it's okay. I mean, that's fine. I get it. A lot of people enjoy that, but it's not investing. And talking about price as a driver of the business, the price has nothing to do with the business. In many cases, you need to actually talk about the business, the trends, the risks, all that sort of stuff. And it's even so, investing is very hard. There's always going to be a degree of luck involved, no matter how good or bad you are. So it's a stressful, it's a fun game. It's a really hard game. It's not for everyone. Now, even speaking about Allison, I trimmed some of my position today. I don't think it's crazy overvalued or anything, but when stuff runs up so much with no real change in the underlying reality, it's like, I'm more apt to want to sell into that rather than pile on.
Yeah, Rod, I wanted to ask you, what's your opinion on Nintendo or any of these gaming stocks?
Well, I own Gravity, which GRVY, it's a Korean company, and I actually was hoping to trim it a little bit. That's the only video game stock I own, which it's a stupid cheap stock, but it's also, there's reasons why it's cheap. You could argue it's a value trap. I mean, the enterprise value had gotten down close to zero again. It's trading, I think, at like a 2 times EV to EBIT right now, but like it's traded at negative enterprise value in the past. Again, like ex-US, a lot of stocks trade very cheaply, and they don't have capital allocation policies that are going to support the share price. If there's no logical buyer, right?
These guys bought back stock recently, right? So,
no, none. They have a huge cash pile on their balance sheet.
Really?
Which is why when you look at the
I thought they
when you look
bought
at
back
the PE ratio, it
back in the
looks
60s.
higher. Gravity, no, they've never done a buyback.
Or was it Gung Ho?
You're thinking of Gung Ho, who owns a big chunk of Gravity.
Oh, okay, so that's the parent company. That's still promising.
Yeah, but to go back to your question about Nintendo, I mean, clearly the value of that IP has been shown maybe in a way that people didn't appreciate with the success of the Super Mario Brothers movie and with the theme parks. I think of Super Mario as just a timeless character. The different characters they own are quite valuable. But again, they're a Japanese listed company who carries a lot of cash, right? They don't have, I don't know Nintendo in and out, but Chris, correct me if I'm wrong, they don't have a repo, and they have, is it a small dividend or any dividend? No.
They have a dividend.
Oh, they do?
I'm pretty sure they do. But I don't think it's showing up there. But they recently announced they're going to invest a few $100 million in a studio after this Mario movie.
Yeah, I think
well,
they
for
got a
them,
partnership
it's the evolution away from being a console-driven company who inherently has that cyclicality of console cycles, and to not have that, right? Because the Switch is obviously long in the tooth, even though demand has held up fantastically and plenty of games have done well, including Tears of the Kingdom, which is, if you haven't played Tears of the Kingdom, I mean, I actually never played Breath of the Wild, and I've been playing Tears of the Kingdom. I don't think you have to have played Breath of the Wild, but it is just an incredible game. That's a
Yeah, I
side
think
note.
the dividend yield is just under 3%. And yeah, I think in May they had their second best month, May, of sales of the Switch.
But they have a huge cash pile, right?
Yeah, I think it's 15 billion of cash equivalent, and
Yeah,
it's like
and
a
that's one of the things with a lot of these Japanese companies is
yeah
that they've historically not had very shareholder-friendly policies. They're very conservative by
yeah.
structure. So,
It's the console cycle thing as well, right? Like if the next console doesn't go well, they need to have a security. They have no debt, um, so that's like
right,
pure cash, basically.
I also
right.
got
So just real quick, like that's the point I was getting with Gravity. Right? If you look at it on a PE basis, it looks more rich because it's not considering the fact that the enterprise value is less than the market
Mhm.
cap in the case of both Nintendo and Gravity. But Sick, go
Yeah.
ahead. Sorry.
I also want to like throw this out there. This happened I think like a day or two ago, but I know Niantic, which is connected with Nintendo through the Pokemon company. They're
Yep.
what was it like? I think they're shutting down like a date like starting today, or like there was like
Yeah. So
mass
this was
mass
yesterday.
layoff.
230 employees laid off,
Oh wow.
and they canceled a handful of like the VR related. This is from TechCrunch. Again, anyone looking at my
Yeah.
screen? I remember
Yeah,
seeing that yesterday, and I know you know that industry. Like, are you hearing from maybe friends who work at different entertainment oriented companies? Like, is this something that's broader
yeah.
than?
Like I started seeing it on LinkedIn yesterday. Like people, so like my connections are like with like other because like the game industry is pretty small, so everyone shares other stuff on like LinkedIn.
Mhm.
They're like, oh yeah, this happened at Niantic today. If anyone needs an art director, like animator, blah blah blah, like just start like a bunch of these start popping up in my LinkedIn feed yesterday. Is what I know, but I'm not sure if like how that would connect with the Nintendo thesis or whatever. And then I also have a question to you, Rod, about your gravity positions after we talk about Nintendo. But yeah, like I mean, like Niantic's not the only one. Like I had, I'm part of a mass layoff. Riot was part of a mass layoff. I
Mhm.
think like October, and same thing with like Microsoft and everybody else. The only one that's like not been hit too hard is maybe Activision, surprisingly enough.
Yeah, Diablo had a really nice month with the Diablo 4 release. They had
It's been a freaking great year for game releases, and there's still a lot of
yeah
good stuff in the back half. I can't wait for
so much
Starfield.
money too compared to other media like movies and stuff. Like this stuff brings in way more money.
It does. It's growing too, and
Yeah.
going back. So Sick, I'll answer you about Gravity in a second. But there was a good story. I think it was either this week or last week in the Journal. It was kind of talking about the theater industry and how it's still not at pre-COVID levels, and will it ever get
Mhm.
back to pre-COVID levels? And it's it. People look at that one, I think it gets more airtime, but then the gaming industry is far larger than it, and it's growing, and it's
Yeah.
likely to continue to grow.
Didn't like it pass the movie industry like about a year ago, or was it before the pandemic? I mean, like the number was pretty. It's pretty substantial by a couple of billion now, right?
Yeah, I remember seeing that. I don't know the exact data of when that happened, but I mean, if you just look on like social media, there's way more young people playing these games rather than like talking about movies. I mean, I guess people are still into the movies, but
Yeah, so it was okay. This
you
is
know,
a little older, but it was talking about domestic box office at least, right? And pre-COVID, it was 11 billion plus or minus going back the decade preceding COVID in U.S. box, and for 22 it was under 8 billion. So it still hasn't even gotten back to pre-COVID levels, and the narrative I think is kind of like, it may still take several years still to get back to the 11.4 that it was at in 2019. And right, consumer consumption patterns around
yeah.
cinematography have clearly evolved over the last few years. So um, Yeah, that's not an industry I really understand why, people love to buy their AMC equity. It doesn't really make much sense to me.
I mean, I think the times of like the Adam Sandler making the like a few movies a year is like over, right? Like they don't really have that revenue stream where they can make a lot of money from these little small releases. They have to really make some big movies that are really good to move the needle when it comes to the media industry.
Well,
Like,
we'll have to see about like what's going to be happening with the media industry. I mean, like
yeah,
even like
yeah.
the movie industry goes through like its own kind of like recessions and pullbacks in both. I guess like the business side and then the creative side kind of follows through. Some
Mhm.
decades like you see more like indie films like pop up, but I mean like recently, I mean like as a business for the last 20 years, most theaters or most studios been going for the whole sequel route just to have like safe numbers in franchises and IPs that they know will work, while padding it in with like other like I guess like semi indie projects. Like for instance, like at Disney, they have when they acquired Fox, they have Searchlight, which does those like random like Wes Anderson movies, like The Banshees of Inisherin and a couple others. And then I know that A24's been just killing it with like the I guess like the lower budget, non crazy films, and a bunch of them did win like a bunch of Academy Awards recently too. So,
What do you think
um,
of these the trends are with the direct to streaming sort of category? Do you see more of these movies just going directly to these websites rather than going to the theaters?
And one other point before the response to that is that beyond just the direct to theaters is just that the theatrical exclusivity window getting sliced in half from that 90-day it used to be, and now it being roughly 45 days. That's just another structural headwind for the industry, for the cinematography, or sorry, the movie theater aspect of it. I mean, it's obviously could be good for the studio, but I just think that the theaters themselves, and it's so tough, right? You have a movie theater that there's only so much you can use that location for, right? You can't do as much with it as a lot of other real estate. You can't really repurpose it. So just
yeah, I remember like the AMC was trying to do those like live events things or whatever, but I've never seen anything happen with those. So honestly, I'll be honest with you. I think the whole like AMC game. It's the same reason. Like I agree with you. Like the whole owning a movie theater chain might be. It's gonna have more headwinds than it's gonna have opportunities at the moment with like the reduction in viewership. But yeah, no, you guys are right though. I mean, like a lot of like movie studios were going DTC just to recoup their costs, but that could have been just because like the COVID thing. But um, if the numbers ever do recover for like theater viewers, who knows? But if some of the data points that like I was seeing, the reason why a lot of people don't even go to theaters anymore, include especially the younger kids, theaters are just way too expensive now. You're instead of paying like back in the days when we paid like $5-10 for a movie ticket, it's like 20-30 bucks for like a movie ticket now, right? For like at an AMC, whether you're watching an IMAX or like a Atmos or whatever the heck you're like watching it in. So
Yeah,
so that this bear in mind, that's going to also be driven by where you live. I know you're in California in a high cost market. So the average ticket cost is still only about $12, and of course, if you're in a high cost market city, it's going to be a lot higher. But you
wait,
are
wait, wait, wait,
right
wait.
that
You're
that's
you're you're paying 12 bucks for a movie theater?
the average movie ticket, and this is according to Intelligence. I don't know who they are, but the Times is citing them. In 22 was $11.75. But bear in mind, right? You've got plenty of theaters in rural and lower cost areas that are going to charge single digit dollars per ticket. So that average is going to get blended across everything.
I think my earlier question is more about like what does it mean for these studios that are releasing these like movies directly to streaming? Are they getting bang for their buck making these movies? how's that going?
Well, it depends on how they structure it. There's a reason why also like a lot of people are striking right now because to give you an example, HBO Max, or I mean it's Max now. While why a lot of writers were striking right now is because the fact that HBO Max became Max, which is no longer HBO, the entity known as HBO no longer exists. I guess legally from that standpoint, they're getting screwed out of royalties. The studio is saving money overhead on like the production and development costs, and a lot of the production structures that used to be for traditional TV just kind of went away, and the writers and like the it's essentially it's good for the studios and bad for anyone working on the actual film. Um, so I mean, like if you're like a multinational corporation, aka the studio, then yeah, it's good for you. But then like the people trying to make a living off it, we're gonna see either A, people just switching out of this field because like it's not financially viable for production folks, or B, there's going to be just more strikes, or C, hopefully, this is what I'm hoping that the studios do, uh, you know, decide to actually up the pay relative to, I guess, like I guess, like inflation, or like, yeah, the craziness of the last couple of years with like price of goods, you know, just living essentially. That's what I'm hoping for. So that, you still continue to see, um, I guess like shows or like media that you enjoy to watch or stream or binge or whatnot, while the studios is still making enough to get by. Because like here's the other thing too, like most movie theaters aren't supposed to be like crazy money makers. Half the time, like a lot of people that come to the movie industry come to do it as like a passion project. What's his name? Who was the last treasury of this the treasurer during the Trump administration? Mnuchin, right?
Yas Minuchin.
Yeah, he was he's a well-known film producer. His background was in finance. Like he knows how to structure deals in order to get like these movies or TV shows created. Enough, ironically, on paper to say that they're losing money, but actually they're gaining money at the back end or something like that. So, but at the end of the day, it still screws over a lot of you know, production writers, directors, whatever folks. While on, well, I guess what I'm trying to say is the studio losses aren't really studio losses per se. I mean, it might come in differently, like on the revenue side. So
What's the impact of the striking film writers and TV writers?
it's kind of like a ripple effect. So it's not just writers that are going to be striking. In about a month, I think. If you've been following, the SAG, AFTRA is also going to be striking also. So if these shows don't get written, like for instance, a lot of these live shows, they don't have the BET Awards. I think was like the most recent award show. They can't have writers, so they're just like pulling stuff out of their own butts. Deadpool, for instance, since Ryan Reynolds is part of the guild, he can't ad lib because he's considered a writer, so he can only use whatever was already written in the script. But overall, like essentially like it's like a factory delay. You stop the writing process, which is like the blueprint for the film. Then the people that decide up the chain to choose which films or TV shows to get greenlit, they don't have a script yet, so they have to wait until the writers do it. So and down the chain, like actors, since they don't have a greenlit script or anything, they can't act or shoot any shows. And then post-production folks, we got no shows to like cut and edit and like clean the audio with, so they're out of work, and it just causes like a chain reaction in the media industry.
Gotcha. So just a lot of bottlenecks.
Yeah. But I don't know. There in terms of also like a couple of the other things in like media, in terms of like the theater sales, I think I'm trying to remember which decree. There was a couple like crap. The Justice Department like ruled on a couple things during like the heyday of like the 1920s or 1930s. One of them was like the Paramount Decree also. So I'm not sure whether it was the Paramount Decree where these theaters can't, or these movie studios can't even buy their own, theaters just to show their own films also. So they're, AMC is kind of limited on who they can sell their theaters to. That's the other problem. But yeah. Anywho, but yeah, that what I want to ask you about your gravity position though. Like dude, I'm Korean, so like I grew up playing Ragnarok, but have they released anything new recently? Or like I thought
So
like the
going
big
back to what Turtle was kind of saying about crowdsourcing research, there's a Gravity Discord server with a bunch of folks from all over the world who kind of follow and crowdsource different kind of sales related data. So Ragnarok, of course, is the core IP that they have a license from the creator through to, I think it's 2032, which there is some terminal risk, of course, of what happens then with the IP license. But yeah, and I mean, there's been other game releases that have had some success. The last 2 quarters in particular, they've had some good success. So it's not just the Ragnarok IP, but that's still like the core that drives that business.
because like I remember like being a couple of years ago, it was like Ragnarok went out of style and it was all about lineage too. Like NCSoft, was it? Or I forget who it was, but yeah, they were making games in Korea.
Yep.
They were like, yeah.
Yep. I can't comment too extensively on that, but yes. But look, I mean, I know we're talking about like where might there be interesting investment opportunities looking into the back half. I've been saying this for some time. I think in the energy space specifically, you've got refiners to me in the U.S. Like if right, we keep talking about how strong the U.S. consumer is. Well, the U.S. consumer runs on gasoline still chiefly, so refined products inventories are pretty low. Capacity to produce them remains constrained and below 2019 levels. So these are not sexy assets, right? No one wants to buy these non-ESG assets, but a lot of them are trading at extraordinarily depressed levels relative to the amount of cash they're going to be producing for many years to come. So I'm very bullish. The U.S. refiners, a lot of them are very, to me, undervalued, and there's some good opportunities there. But energy year to date, right, has been pretty weak as a sector. It's down over 5% year to date. The upstream stuff is still maybe a little more questionable, especially domestic upstream. But when I think about where there are mismatches, and structural shortages in supply relative to demand, I look at refining, and I think there's a lot of interesting stuff there. You guys have probably heard me in other venues refer to PBF Energy. One of the independents, they have about a million, a little over a million barrel throughput for chiefly gasoline and then diesel. And trading again, if you look at a stock chart, which a lot of people, that's all they do. And people say, "Oh yeah, stock chart looks fine." It's up a lot, so it's up toward levels last seen 5 years ago. But then you got to look at the balance sheet. A lot of these energy companies, they've completely changed their balance sheets in terms of eliminating all the debt. So that's a space I think is still very interesting, and we'll see how the back half goes. If energy comes back into favor, it's been obviously the least favored sector from kind of the hot money crowd year to date.
I'm in the other PB, man. I'm bullish PBR.
That's right. You're PBR, which in my personal account I do own PBRA. and we've had this conversation in other spaces. I don't see Chapman in here, but in my view, I don't really see why to hold the common stock over the preferred, given they're going to pay you out, the same number of dollars. You can own more shares of the preferred, right, and get paid the same dividend. There's a little bit of difference between them, but
Yeah, you're 100% correct. I completely switched out of PBR into PBRA because of that. I was like, okay, you might as well get a little bit more shares and a little bit more divvies because that's the main strategy and hold for,
yeah, definitely something you want to hold in a tax advantaged account, given how much cash returns they're providing through these really rich dividend policies. Yeah. All right, 5:30. So I'm gonna let this go, I guess, through till about 6. If we have stuff folks want to keep talking about, anyone listening, if you want to come up, ask any questions, or me or any of the folks on the panel, feel free. We can get our weekend started. But I would circle back to one thing Monad said earlier about how inexpensive insurance is right now. And I heard Steve Sosnick at Interactive Brokers mention this on an interview this week as well. You want to be buying insurance when you don't need it and it's cheap, rather than when there's a storm. So I think whether it's a single stock hedge, whether it's writing a call and buying a put, a collar, whether it's buying a sector hedge, a lot of that stuff is just very inexpensive right now. And the wonderful thing about those hedges is if markets or that security or sector does drop, then you're able to liquidate those hedges and have a wonderful cash pile that you can redeploy at a low or at a more attractive entry. So I do think I hear a lot of people now saying that there's no risk anymore and volatility is going to keep going down, and it may, but the time to buy the insurance is when it's cheap and when everyone's euphoric, rather than when everyone's screaming and things are on fire. Okay, well, Steve, I saw you came up. Do you want to chime in?
Yeah. Hey, what's going on? Yeah. Did you get your car fixed?
I did, thankfully, fixed under warranty.
Yeah. Congrats.
Appreciate it.
Yeah. So I saw your headlines about NVDA, but just wanna I don't know if you could talk about Overstock. Officially take over the BBNY online portion of it. So
Yeah.
it'll be like one would be like was 40% revenue from BBNY online, right? So you could get like a 2 times on the percentage EBITDA increase. So that would be I think a good deal for their for the company.
Yeah, it's an interesting strategic decision, right? They've opted to go ahead and rebrand Overstock, the .com to use the BedBathAndBeyond.com that they acquired for $21.5 million. So they got the customer list. I'm sure it will be accretive. I guess my thing is it worth the stock going up 50 whatever percent it's gone up in the last month. It's up 73% now in the last month. Market cap's back up to $1.5 billion. The homeware is kind of sector is still challenged and still has more pain ahead. So I'm actually kind of thinking the overstock move should be faded. I actually sold all of the overstock that was in my girlfriend's account today for her today, um, because I'm quite confident overstock will be revisiting the teams before the things are said and done. At least, look, that's again, that's more of a price versus fundamental discussion. I think it helped Overstock's business. I think Johnson Johnson made the right decision, and they scooped a pretty attractive asset for a lot less than it's going to deliver to them. But is it delivering to them hundreds of millions of dollars of value? I think it's a little too early to say, and I'll wait to see a couple quarters of I always follow Overstock, having been invested, although I don't own any shares today. We'll hear what second quarter results look like, what the outlook looks like, what kind of early results they're seeing from the rebrand. But to me, it's like, all right, it already baked in more than it should have. Is kind of my short impulse, or my short-term impulse.
I think I mean, oil stock in any L-shaped chart, you might want to take a pause. But I think probably a better fade probably be Wayfair, because that just catch up on nowhere.
Yep. I sold in my personal account. I wrote a $65 strike call for I think a month or two out. I'm happy to get short Wayfair. Around a $70 or so cost basis. I'm with you there. Wayfair to me it's absurd that it ran up like it has over the last month. It's almost doubled, and that's just. I don't have anything good to say about Wayfair.
Yep, there's always the risk of surprise, but you have to look at the. I think sales side is kind of positive on their next quarter, so we'll see what's going to be happening. I think, and so I don't know if you guys talk about NVDA. So one thing I was going to mention for NVIDIA, just I know valuation doesn't make a story right now, but so Dornemann, Professor Dornemann actually released his latest valuation on NVIDIA. I think earlier last week. I don't know if you guys
yes,
was able to take a look, and then
it was 240, right?
You're talking about per share basis? Yeah.
Yes.
Something like that. Yeah. And it's like 500 billion on the enterprise value, equity value, which is actually similar to what I get. But I think it's interesting. He get to so basically his base case for the AI market share for NVIDIA, it's actually 60%, and then he's looking for around 300 billion market share, total addressable market. And then I think I was just going through his valuation. He seems like he's struggling to get to that the EV market, the growth rate for the EV market beyond a 50% number, which is interesting. He made an interesting point, right? I know you got a lot of traders here. He mentioned point about momentum and then value investing. It's like, okay, if you're a trader, you can make the argument that any company that's carrying a momentum, expecting momentum to continue, but he also raised that the pushback will be the momentum also can carry a stock forward, but however it could be both to give it that to take away. Right?
I pinned his thread, by the way, for anyone who hasn't seen it yet from last week.
Yeah, it's a very detailed model actually. It's a very comprehensive model. So if anybody want to take a look, it's very interesting.
But it boils down to him basically saying, even with operating margins getting to 40% over the next decade, and with revenues going up 10 times over that period, that still only brings the value to that $240 per share level, right? So of course, it can keep going up in the short term, and very well could, right? Monative keeps pointing out that it seems pretty clear that they're going to have some blowout results as people are trying to buy everything and anything they can get their hands on. But again, I keep saying, how much of this is just going to be very much like, a Cisco situation where you get a huge run up in people buying up everything and front loading, pulling forward that demand. At some point, it's going to get given back, and then will the price fall off a cliff? Even though the business is going to, of course, probably just keep getting better, that just deep disconnect from intrinsic value and price is too wide to overcome to give you a good forward return.
Yeah, I know. I think it's so. It's interesting. So there's a guy. His name, I think he's on CNBC. His name is Dan or something. He's been a big NVIDIA bear since I don't know, last year. And then I was expecting. I was looking for like whenever he gives up, throw the towel. That's probably the real top because you get it's like it's you have this type of narrative driven. It's momentum driven environment. Anything can happen, but. Yeah, you're right. Like anything, not just that, but also we've not just the bottom up approach, but if we're just talking about the discount rate or the WACC, you have to count this to the 1970 area where the interest rate was going up like a roller coaster and going down like a roller coaster, and then that's gonna have some effect. But yeah, that's the
Oh yeah,
fundamental.
what was the discount rate he used in the analysis? Do you know?
It was about 11 or 12. I have to check. I think that was the
Okay, I
WACC.
see it. Yeah, he's got cost of capital declining in the first 5 years. He's got it at 12%, and then by
Yeah.
year 10, it's down to just under 9.
Yep. So yeah, you have that. But I think NVIDIA is interesting because their China represent like 20 to 12 like 20% of their data center sales, right? So
Yep.
you have to also look at
That's
China.
something we were talking about earlier with what Monadev was kind of noting about Apple, at least in particular, was not just the production risk exposure to China, but the consumption risk from China for Apple, at least. And to your point about NVIDIA, yeah, we were talking about that earlier too, that 20-ish%. On Wednesday, we were talking about all the chips that are getting like smuggled on the black market, people paying 100% markups to get them in China. But you're right, the geopolitical risk is absolutely not baked into these some of these companies. Like if people truly think there's a risk of further decoupling or just of the Chinese economy going poorly or whatever, those risks don't seem priced.
Yeah, well, yeah, it's like two-sided. You have this two-sided story because so China is interesting because the PMI this week was kind of weak, was still below 50, which is contractionary, right? But here's the problem. You have a very complacent, based judge on the equity performance. You can call it very complacent market. But the Chinese market, it's a totally was a 180 story. So yeah, there's Tower to City right here. So if right now, right, if you're looking at, we just had a Dragon Boat Festival in China, and then the based on the local data, right, so the traffic was kind of weaker than the prior holiday period, right? So with all the weaker or decelerating or slower economic data from China, I would be surprised the PBOC to do more easing policy in the second half of this year, right? So when that comes, then you might see some sort of relief measure, but that's a different story. But that would be interesting because right now, right, the Chinese equity is just not getting a lot of love right now, especially even domestically. Nobody want to touch it. Housing demand is very low. So it's like complete 180 of U.S. sentiment right now. So it's an interesting environment.
Yep. Good thoughts. Appreciate it. About 20 minutes till I'm going to wrap this. So again, anyone who wanted to ask any questions or chime in, please feel free to request to come up. We'll bring you up. We've kind of touched on the richness of tech, I guess. We talked about movies, gaming, a lot of consumer stuff. I think we talked about it a little bit last week. Obviously, we keep getting, as each day goes by, it seems another automotive OEM opting to utilize the North American charging standard from Tesla. And I still get back to how much Tesla's value had gone up and what is that in effect actually worth to the firm. And it just, again, is one of those things where I think the news flow and the hyperbolic narrative is disconnected from the underlying benefit to the business. I mentioned, I tweeted this afternoon that I have I'm short in my personal account some Tesla shares. I also rolled a naked call that I keep monetizing, the 275 strike to next Friday. And I mean, the premium on these is just insane. The activity, as everyone I'm sure knows, like Tesla just remains such a massive portion of retail frenzied activity in both the options market and in shares. So, who knows, right, what it could do over the short run. But I'm inclined to think that there's actually going to be a pretty nasty surprise come the next earnings report, because they've sliced prices and we're going to see some pretty ugly margins, I think, as a result of that. And to me, the Tesla story has always been a very narrative driven one, and perhaps it will ignore the operational realities. But if the narrative was that Elon kind of saying top line will grow for 50% for many years, it's clearly not. It's not going to grow like that. And now margins are degrading. So I'm really just not sure what the thesis for Tesla is, other than hope for robo-taxis and AI somehow delivering stupendous value to the firm. A lot of the sell side people who cover it, they kind of explicitly modeled in robo-taxi and full self-driving and all this stuff. And it seems like the bulk of the value for the firm you have to assume that there's something extraordinary like that comes to commercial reality. Otherwise, it's just a car company.
No, I would say Kathy would disagree.
Kathy's analysts would disagree. They've been calling for peak oil for a while now, too.
The petroleum, or you're talking about something else? Actually, one thing I want to mention, we're talking about the big fan. So if you're looking at under the table, there's one company actually is not performing as other the peers. This company, probably everybody knows, Alphabet, which is Google. It's quite surprising because they have all the narrative they have, right? They have the AI narrative. They have the recovery narrative in terms of search. So, people are not saying buying their story, but I think it's very interesting to look at. Obviously, you have to look at what's the next quarter axiom, but just for the positive side, if any company will surprise to the upside, Alphabet will be one of the candidates, because if you look at the May search volume for advertising, historically it's a very weak seasonality quarter, but it actually been performing quite well. So, and then if you add on the same LLM model they use in ChatGPT, and then the bird there's some sort of engineering differences, but I would say if you want to do a probability bet, like just long short equity story, I mean, I think Alphabet proposed some sort of it could be if you're gonna short on the short side, you could put another pair. It depends on whatever beta adjustment is, but I think that's an interesting company to look at.
Yeah, Alphabet relative to historical valuations it does look still pretty attractive. And you're right. I think that narrative perhaps has been overblown. The idea that they're losing in AI and that search is going to rapidly go away. I mean, at least very short-term impulse, you would think, with how resilient consumer services have continued to be, that's helpful for them and their business. So yeah, that makes sense, but no position personally. it's funny. I remember late last year, kind of joking around. I was like, wow, these tech companies are starting to almost get cheap. And they all were almost to a point that I would actually consider, thinking that there was a good forward return. And obviously I didn't bite. I only nibbled on Meta and let it go far too quickly. But
Yeah, I think Dorman. I think Professor Dorman is the ultimate dip buyer. He actually bought Tesla at a low, and then he bought Nvidia at a low. So it's quite interesting if you look at his track record.
the dean evaluation strikes again.
The only thing that I will say about the whole dip buying thing, I am a little peeved. When what was it, like Michael Burry was like sell, I was like, oh crap, I think maybe something's happening. All right, let's hold off on buying the dip for now. And then he was like, oh shoot, I was wrong by, what was it, like March? I was like, god damn it.
Can't let other people drive your decision-making processes sick. But look, I mean, one big overarching theme we didn't talk about today, but that a lot of folks have been talking about. You had the GMO Montier on Odd Lots talking about. I've seen a lot more discussion around it in the last few weeks. It's just how overwhelming the impulse from fiscal, just this massive fiscal deficit that is continuing to fuel things. And if right, if only we'd done this out of the great financial crisis, just poured massive fiscal stimulus on, perhaps the economy would be far richer and we would all be far better off. But we're at a 8-ish% deficit, yet unemployment, we're at max unemployment, right? So it's like that's another, I think, aspect when people obsess over the Fed in their discussions and they kind of ignore the fiscal side of the equation, which is clearly driving a lot of activity that, again, we've talked about the construction activity from IRA, infrastructure chips, and how that relates. But Skyscanner deal. Ooh, Skyscanner. That's a name I've not heard in a long time.
Yeah,
Chime in.
I tried to make an affiliate account back in the day, then I got really lazy and abandoned it very quickly. And then but anyway, but I think Syke mentioned something about Michael Burry when he said he was wrong. He was actually trolling when he made that post, right? So it wasn't really an admission, because when he said to sell, I don't remember the exact price level, but when he said sell, SPY was at the price level that when he said he was wrong, it was at the same price level. And then there were like a month later, and there's a trough in between, right? So it was basically just him trolling. And as far as the topic goes for market talk or positioning for second half, I just think that looking at 1983, just recently everyone's talking about this best year since 1983 or best first half since 1983. There's there's big drawdowns in the second half of that year. That's what people aren't saying. And with the Fed kind of doing this pause right now with their confusing messages, I think that a lot of people do call me a perma bear, but I think that's pretty bearish that they're taking this pause right now, despite core being so sticky and it's not really matching. Their messaging is not really matching their actions are not matching their messaging or their mandate. So, which means it's just kind of suspicious with the underlying. So, I would just tread carefully in the second half.
And I'll note it because I think Chris, you might have been I think he left, but there is a 5% chance priced in that there are 3 hikes come December. And the market is not pricing in cuts anymore, and it is still pricing in 1 point some odd hikes. But yeah, I think the Fed, the transitory message of 21, a big chunk of that is likely being proven true. But I think the challenge is that it doesn't seem clear to me, and I don't know who really buys the notion that with their current trajectory, we're going to return to their target. It does seem like it's only going to get us somewhat of the way to the 2% PCE target that they have. So, that they continue to say, I think, in some as a committee, that the bias is to raise more and to err on the side of over tightening rather than under tightening. So the equity market, just for the time being, has seemingly still, like you kind of implied, ignored a lot of that.
Well, they consistently say that they'd rather overdo it than underdo it,
Mm-hmm.
and that is tough talk, right?
Mm-hmm.
But at the end of the day, these 0.25 hikes, they do a lot of damage to these long-term bonds that the banks are holding, and maybe this pause was in recognition of that and allowing banks to position themselves and hedge for that. Maybe, I don't know. I'm just purely speculating, and also like maybe the Fed is planning to do some liquidity tricks, and behind the scenes, and like I haven't seen it yet, but maybe they could be doing a rug pull on liquidity, and maybe they're factoring in their own action. That was my main theory for the pause, but I don't know. Like, there's a lot of confusion out there, and I don't think anyone knows definitively why they paused. Because there could have been some data that they could have been live tracking that would have supported that pause, but really nothing's come in yet to really support that pause so far. So I don't know if you have any thoughts on that or anyone else.
I don't know if you listened to the panel they had, the ECB panel this week with Christine Lagarde and Powell, and then
Yep.
and a bunch of the big four. And then when they asked him about the term, right? So he said, "Oh, it was you're not calling it a pause. You're not calling it a skip. What are you calling it?" And he's like, "I'm just calling it the decision we made by we're not doing anything at this current juncture." That he just really repeat his statement. He's like, "We're not calling anything."
That makes it less confusing, doesn't it?
Yep.
No, that was an interesting panel, and but it was like more tough talk, right? And you see Germany. Like, correct me if I'm wrong, but what's going on in Germany right now is stagflation, because their inflation's been kicking up. They're in a technical recession right now, I believe, and we're going to see this more on a global basis. And it's just, in every second that I am long intraday, I hate myself by by going long on the cues. But sometimes you just got to follow the flows. But I mean, to my core, I hate myself every time I go long in this kind of market. I think equity risk premium right now is like what,
It's
1%?
non-existent.
Yeah, exactly. It's just shattered, and it's right at that point. It's at that same low at 2007, 2008, when things just went holistically the other way, and we are. And I mean, coming from a perma bear, I guess, quote unquote, for myself, um, that we're really primed to go that other way, and maybe this rally at the same time with liquidity. Maybe a lot of people were front running this summer rally, right? And things have kind of gone opposite of what you might expect. And correct me if I'm wrong, but I think most people are kind of expecting. So maybe we go the opposite way. I don't know.
I mean, I
So
always say this: you don't have to, I don't know, Monative would. He's heard us. We've had this discussion ad nauseum, but you don't have to buy the index. You can opt, to not invest and get your lovely 5-ish% cash yield. And there are areas of the market that are historically cheap. Again, certain areas within staples, within energy. Look, of course, trailing cash flows from energy are elevated still, but there's, to me, a lot of value to be found in the energy space. There's a lot of value to be found in the nicotine space. Some industrials, defense. Some of that stuff is, again, the unsexy stuff, the stuff people don't
Yeah.
talk about on Twitter Spaces.
Speaking of unsexy, 3M, 3M broke below broke below 100, and it's like multi-year. I think it hasn't been that low since 2012, right? It's got a nice yield on it. Typically, the yield isn't this good.
3M has certain litigation risk that's kind of hanging over it, right?
Oh, I've only been following the tape. I haven't been following the company news or anything like that. But like, what kind of litigations right now? Is it going on in the States or?
Oh man, I don't follow the company closely. I'm just regurgitating what I thought I saw in the headlines. They have the earplug lawsuit. Just last week, they reached a $10 billion settlement for some drinking water contamination.
Their market cap is 55, so 10's nothing to sneeze at or scoff at. I was going to say every blue chip has its warts, but 10 billion, yeah.
Right, and that's not the only one. They
It's
have
a
this
team.
earplug lawsuit. They've been trying to put a subsidiary, and this is a strategy that I know is it SC Johnson or Johnson & Johnson, one of the two, had also been trying to follow with the talc lawsuits, where they're trying to get rid of these liabilities by declaring bankruptcy on a subsidiary, and the courts have kind of been like, no, we're not letting you do that. So there's some of these overhangs for those two companies that, again, just looking at a chart obviously isn't going to tell you that information, and you definitely, at that point you need to have a view on how impactful litigation is going to be. It definitely raises the risk of getting it wrong, and maybe it looks cheap, but there's probably, in that case, at least a good reason.
Does a special purpose entity structure, an SPE structure, so you're saying that doesn't protect them in a litigation like that? Is that what the courts are saying, basically?
So Johnson & Johnson, here I'm just pulling up the story from earlier in the week. So they have this $8.9 billion talc settlement, and they are trying to file for bankruptcy on a subsidiary. So that was dismissed in April because the subsidiary was not in financial distress and therefore not eligible for bankruptcy protection. Right. So these companies are trying to offload the liabilities, file bankruptcy, and then kind of backstop them with cash from the parent, but have the parent not be on the hook. It's like a really convoluted, and I'm not a bankruptcy expert by any stretch, so I've been following it loosely. It seems like so far, the corporations have been unsuccessful in this, which you got to think anybody like a 3M or J&J that has a big overhanging liability like this, if they can't get rid of it, they're going to have to pay the piper, and that, it's obviously going to eat away at shareholder value.
But from the sounds of it, that the subsidiary has enough funds to be solvent after, like they have enough funds to pay that liability. No, it's just a matter of them
convoluted.
not.
I don't
it
fully
sounds
understand it.
Yeah, it sounds like it's just a matter of that they can't declare the subsidiary. Just looking at the subsidiary alone, without considering the parent, they can't declare bankruptcy if they have the money to pay off.
Right. That's what the court's saying.
Yeah, because I thought it was a matter of that. Say if I was thinking that the subsidiary did not have adequate funds to settle the litigation or pay the settlement, then the parent can still be on the hook for that, and that there's no special purpose entity protection from that structure, like an Enron kind of thing. But anyway.
Yep. All right. Well, look, it's 6:02, so very much appreciate folks tuning in, your interest in the discussion. It was a good discussion this afternoon. We had to cover a variety of topics. So thank you very much for everybody who came up and participated in the discussion on the speaker panel. Very much thank you guys. I know some of you aren't here anymore, but appreciate it. We'll be back next week, same time, same place, with our Friday Wook in Review. Also, follow my personal handle at Rod Alsman. I do host an open mic on Wednesdays, 7 Eastern. We'll be back to have that next week. And we'll hope everyone has a great weekend. If you're stateside and you're having a long one, hope you enjoy it and celebrate the country's Independence Day on Tuesday. Again, shortened market session on Monday. So thanks again, everybody, for your interest in Wook Capital. Hope everyone has a good weekend. Talk soon. Cheers.